To construct a durable and sustainable investment portfolio, it is important to achieve the right balance between various physical and financial asset classes. Today, we will focus on how investors can construct a robust equity portfolio to achieve their desired financial goals while keeping risk and reward in mind. Portfolio diversification can be achieved across four major axes: market capitalization, business maturity, asset allocation, and sectors. As most investors are aware, listed companies are broadly classified into microcap, small cap, mid cap, and large cap companies. Currently, there are over 5,000 companies listed on the BSE and more than 2,000 on the NSE. Large cap stocks, as defined by SEBI, include the top 100 companies based on market capitalization, while mid caps encompass companies ranked from 101 to 250, and small caps range from the 251st position and beyond. SEBI does not provide a specific definition for microcap stocks, but companies falling outside the top 500 in terms of market capitalization are typically referred to as microcap stocks. In terms of risk and returns, microcap and small cap companies are considered high risk investments, and consequently they are expected to yield high returns. The variability in returns is substantial, which means that investors planning to construct a portfolio solely consisting of small cap stocks must be comfortable with significant portfolio fluctuations. It is not advisable for retail investors to have only small cap stocks in their portfolio. Mid cap stocks are regarded as moderate risk investments and are expected to deliver moderate to high returns. Personally, I favor fundamentally strong mid cap stocks due to their proven business models, robust management, clear visibility in terms of revenue and profit growth, and a high likelihood of evolving into large cap stocks in the future. Large cap companies, especially blue chip ones, are considered bellwether stocks. They offer crucial stability and support to a portfolio during market volatility. It is advisable to construct a stock portfolio that spans various market capitalizations. Conservative and passive investors may opt to allocate 80% of their investments to large cap blue chip companies and allocate the remaining 20% to small and mid cap stocks. Investors with a moderate risk appetite might consider a portfolio allocation of 50% in large cap, 30% in mid cap, and 20% in small cap stocks. Those who are willing to take on high level of risk can increase their exposure to small cap stocks to 50%, with 30% in mid cap and 20% in large cap. The second dimension of company positioning is drawn from Peter Lynch's book, One Up on Wall Street. Lynch has eloquently classified companies based on their life cycle stage and business maturity into 6 general categories, which I have incorporated into my investment strategy. These categories are slow growers, stalwarts, fast growers, cyclicals, asset plays, and turnarounds. Stalwarts are companies that exhibit consistent year-on-year annual earnings growth of 10 to 15%. Many of these companies are part of the Nifty 50 or Nifty 100 index. Stalwarts offered good protection during economic downturns. Depending on when and at what price investors acquire them, there is potential for significant profit. The typical holding period for stalwarts range from 1 to 3 years, and once investors see a 30 to 50% profit, it is advisable to take the profit and shift to other stalwarts available at reasonable valuations. Fast growers are small, aggressive new enterprises that consistently grow at a rate of 20 to 25%. It's crucial to identify companies with strong balance sheets, excellent management, and high profit margins. The growth rate must be sustainable for the next 5 to 10 years, and it's not mandatory for the company to belong to a fast-growing industry. Slow growers generally exhibit very gradual growth, more or less in line with the nation's GDP. These stocks typically start as fast growers and eventually plateau. Every once popular fast-growing industry eventually becomes a slow-growing one. It's worth noting that slow growers often pay generous and regular dividends. Cyclicals companies experience regular, if not entirely predictable, fluctuations in sales and profits. When the economy emerges from a recession and shows sign of recovery, cyclical companies tend to prosper, with their stock prices rising faster than those of stalwarts. Timing is crucial with cyclicals, and investors need a solid understanding of the business cycle and the demand supply dynamics of the industry. Turnaround candidates are typically companies that have faced challenges, are struggling, and may be close to bankruptcy. Bailouts, takeovers, and restructuring under the Insolvency and Bankruptcy Code, or discovering a well performing company within a financially distressed one, are examples where investors can identify turnaround potential. Notably, among all categories of stocks, turnarounds are the least influenced by general market trends. Asset play involved valuing companies based on specific assets on their books that have been overlooked by analysts, which can add to the company's overall valuation. It's important to recognize that companies do not remain fixed in a single category indefinitely. For instance, a company may begin as a fast grower, transition into a stalwart, and eventually evolve into a slow grower. Conversely, a slow grower might introduce new products, services, or business lines and shift into the fast grower category. Therefore, investors should regularly reevaluate and reclassify companies based on their changing business positions. Slow growers are generally considered low risk, low gain investments, primarily sought after for income generation through dividends. Stalwarts fall into the category of low risk, moderate gain investments, serving as short term options. They contribute to portfolio stability and offer moderate capital gains alongside dividend income. Asset plays represent low risk, high gain investments, but demand a specialized understanding of financial statements to identify suitable opportunities. Cyclicals can be either low risk, high gain or high risk, low gain investments, depending on one's ability to anticipate changes in economic cycles. For retail investors, it's advisable to diversify investments across multiple stock categories. Asset plays and cyclicals can be challenging for individuals who lack the necessary expertise to identify potential opportunities. The third axis involves identifying sector correlations and selecting sectors that have low interrelation. To comprehend the correlation between different equity sectors, we will utilize 11 indices from BSE. The initial step is to compute the yearly percentage returns for each index from 2005 to 2022, which can be sourced from the NSE and BSE website. The subsequent step is to calculate the correlation coefficient, a measure of how the movement of one index influences other. The resulting matrix will be as follows. The correlation of index with itself will be 1. If the coefficient is less than 0.5, the sectors are poorly correlated. If it falls between 0.5 to 0.7, they are moderately correlated. If it's above 0.7, they are highly correlated. Suppose we take IT as our reference index. In studying its correlation with other sectors, we observe that FMCG, realty, oil and gas, capital goods, banks, and consumer durables have a correlation coefficient below 0.5 with the IT sector. Consequently, investors can contemplate building a stock portfolio comprising stocks from these sectors. Please note that for simplicity, only the correlation of IT with the 6 shortlisted sectors has been considered, and correlations among the 6 sectors with each other were not taken into account. Formulating a prudent portfolio diversification strategy is crucial for investors and may necessitate periodic adjustments as individual risk appetites evolve over time. Here are some high-level guidelines that I follow. Determine the appropriate allocation across financial and physical asset classes based on your financial goals, investment duration, and risk tolerance. For investors with a time horizon of more than 15 years, consider the following allocations. For conservative investors, 50% in large cap, 30% in mid cap, and 20% in small cap funds. For aggressive investors, 50% in small cap, 30% in mid cap, and 20% in large cap funds. Avoid investing in more than 6 funds and review the top 10 holdings of selected funds to prevent overlap. When investing directly in equities, I adhere to these rules. Limit investments to not more than 2 to 5% of capital in one single company. Invest only in sectors that I can understand and can track regularly. For example, IT, pharma, FMCG, consumer durables, banking, and consumer discretionary are some of the sectors which I track regularly. Do not allocate more than 15% of total capital to a single sector. Document 10 reasons for purchasing each stock and review them every 6 months to ensure their validity or improvement or worsening. I focus on categories such as fast growers, stalwarts, and turnarounds, while avoiding asset plays and slow growers. The number of companies in your portfolio can vary, but a general guideline is around 15 to 20 companies for large cap portfolios and around 30 for multi-cap allocations. If you follow the 2% capital allocation rule per company, you can hold a maximum of 50 companies in your portfolio at any given time. Portfolio diversification can evolve over time. For example, you can begin by investing small amounts in few companies and gradually transition to larger positions as your confidence and capital grow. Consider using liquid funds to park money initially, selling units to invest in stocks when suitable opportunities arise. These guidelines provide a structured approach to building and maintaining an investment portfolio that aligns with your financial goals and risk tolerance while ensuring effective diversification. Adjustments should be made as your circumstances and investment knowledge develop. If you appreciate the work I am doing, then please like and share the video and also subscribe to my channel.